All right, today we're going to do something kind of cool. We're going to tear apart a stock analyst report to figure out why a really famous company suddenly got a bit of a warning sign put on it. We're talking about the luggage giant VIP Industries and a recent stock downgrade that you'll see tells a much, much bigger story. You ever wonder about that? Why does a company's stock rating just change out of the blue? What are the secret signals that these Wall Street analysts are picking up on that maybe the rest of us are missing? Okay, let's dive right in. We're going to unpack the recent stock downgrade of the luggage maker VIP Industries. The call was made by a financial firm called Elara Capital, and it's just a perfect case study to understand how the pros really look at a business. So, first things first, a stock gets downgraded. The big headline here was that Elara Capital changed its official recommendation for VIP stock, shifting it from a buy to something called accumulate. So what on earth does that actually mean? Well, Elara lays it out for us. A buy rating means they expected the stock to go up more than 20%. This new accumulate rating, well, it means they still think it'll go up, but in a more modest range, somewhere between 5 and 20%. So it's not a sell alarm by any means, but it's definitely them tapping the brakes. And here is where it gets interesting. Even with the downgrade, they kept their price target for the stock exactly the same, 430 rupees. Now that's a bit of a head-scratcher, right? It tells you the downgrade isn't really about the company's long-term potential. It's more about some short-term hurdles, and the fact that the stock had already gone up a bit, closing the distance to that target price. All right, let's get into the nitty-gritty. It's time to look at the reasons why, the actual diagnosis that led to this downgrade. So what did Elara Capital see? Well, they saw what you might call a perfect storm of three big pressures. First, the company was having to use heavy discounts just to get old products off the shelves. Second, they're getting hit hard by a ton of new online competitors. And third, this weakness wasn't just in one place. It was everywhere, in their physical stores and on their website. And that point about new players is so important. A lot of them are what we call D2C, or direct-to-consumer brands. You've seen them, right? They're all over social media. They skip the department stores and just sell straight to you online. It means they can be faster, trendier, and put a ton of pressure on an established company like VIP. Okay, now for the cold, hard proof. Let's dig into the numbers that back up this whole diagnosis. We're looking at the results from the third quarter of their fiscal year. First, let's look at sales, the top line. Revenue didn't just stumble, it fell almost 9.5% compared to the same time last year. But here's the real kicker. That was more than 6% worse than what the experts were expecting. That's a huge miss. It's a clear signal that something is seriously off. And this number shows what that did to their profits. The company's gross margin just collapsed by 1,707 basis points. Now, BPS sounds complicated, but it's not. 100 basis points is just 1%. So we're talking about a massive 17 percentage point drop. That is an absolutely brutal hit to how much money they make on each and every sale. So where did all that profit go? Well, here's the main culprit, a massive inventory write-off of over 54 crore rupees. Just think about it like this. If you own a store and you've got a warehouse full of last season's fashion, at some point you have to admit it's not going to sell and just take the loss. That's what VIP had to do, for the second quarter in a row. For an analyst, that's a giant red flag. I know charts can be a little intimidating, but these two tell a simple and pretty brutal story. Look at the top chart. See that last bar for revenue? It just takes a complete nosedive. But the real drama is in the chart below. That green line, that's their core profit margin. And just look at it. It completely falls off a cliff, going deep into negative territory. That means they were actually losing money on their core business. It's a powerful visual of just how bad things got. Okay, so we've seen the ugly numbers. Now let's zoom out and talk about the bigger picture, the deeper, more strategic problems the company is facing right now. This direct quote from the Elara Capital report it says it all. They talk about limited strategic visibility. You know what that's code for? It means we're not sure what the plan is here. They're pointing to instability at the very top of the company and some real fundamental problems with how people see their brands and where they're sold. And this all boils down to a pretty scary list of risks. The analysts are basically asking, can VIP win back the customers it's losing? Can it actually handle all this new competition? What's it going to do about the crazy prices of raw materials? And can it please stop the revolving door in the executive suite? These are really serious hurdles. So with all of that on the table, what's next? What do the analysts think is going to happen from here? This little table sums it up perfectly. Because of all these problems, the analysts went back to their spreadsheets and just cut their forecasts. You can see they've lowered their expectations for sales over the next 3 years. They're basically saying, yeah, this turnaround is going to take a lot longer than we originally thought. But, it's not all doom and gloom. Despite all this short-term pain, the analysts do see a light at the end of the tunnel. They are projecting that VIP can get its profit margin back to a much healthier 10.2%. Eventually. But, and this is the key, that's only if the company can successfully navigate all those huge risks we just talked about. And that really leaves us with this one final massive question. And it's a question that goes way beyond just one luggage company. Can a legacy brand, a household name like VIP, really reinvent itself to fight back against this new age of super fast online competition? Their story is going to be one to watch, for sure.
Welcome back to the Deep Dive. We are really glad you're here with us today. We are actually shifting gears a little bit for this one.
Yeah, quite a bit, actually.
Right, because usually when we sit down to record this, we have, a table just full of sources, articles, research PDFs, maybe a manifesto or two.
It's usually a giant collage of text.
Exactly, just walls of text. But today we are zooming in on a single image.
Just one.
Yeah.
But I have to say it is a very dense, very telling image.
It really is. We're looking at a snapshot in time. Specifically, we are going to unpack a technical stock chart for VIP Industries.
Right, the ticker symbol is VIEAD.
VIPIN on the National Stock Exchange. And just to orient everyone listening so you know exactly where we are standing, the data on this chart cuts off on Saturday, February 21, 2026.
Which is important because it means the market is closed, the chaos has stopped for a moment.
Right.
And honestly, that's actually my favorite time to look at a chart. It's like walking onto a playing field after the game is completely over.
I like that.
You can see the footprints in the mud, you can see where the skirmishes happen, but without the noise of the crowd distracting you.
I love that analogy. It's like a forensic analysis. And I think for a lot of people, maybe for you listening at home, these charts just look like squiggly lines or, I don't know, random geometry. But you view them differently, don't you?
I do, absolutely. To me, a chart like this isn't just math. It's not just pure data. It's a psychological map.
A psychological map.
Exactly. Every single red bar, every green bar, every long wick on those candles, it represents thousands of human beings making decisions.
Real money on the line.
Exactly.
Okay.
It's fear, it's greed, it's hesitation, and occasionally it's absolute conviction. You are looking at the emotional history of money over the last 3 months.
So our mission today is to decode that map. We are going to act like detectives and figure out the story of VIP Industries leading up to this specific Saturday in February.
Let's do it.
And looking at the screen here, we have a lot to unpack. We've got candles, moving averages, massive volume spikes. But let's just start with the scoreboard.
The raw data.
Right. Top left corner of the image. What are the headline numbers telling us about the very last trading session?
Okay, so let's look at the raw data first. We opened the session at 356.00.
Got it.
We hit a high of 371.00. We dipped to a low of 354.80, and we finally closed the day at 368.00.
Okay, let's do some quick math on the fly here. It opened at 356, closed at 368. So that's a 12-point gain.
It is. And visually, that gives us a green candle on the far right of the chart. But, the color is actually less important than the journey the price took to get there.
How so?
Well, look at the low is 354.80, and the open was 356.00. They are almost identical.
Meaning the price didn't really spend much time going down.
Exactly. As soon as the market opened, the sellers maybe tried to push it down for a few minutes, but they just completely failed. The buyers stepped in almost immediately.
Right.
And then look at the high versus the close. We had a high of 371 and a close of 368.
So it closed pretty near the top of its daily range?
It did. And often, especially on a Friday or right before a break, you see traders taking profits at the end of the day.
Right, cashing out before the weekend.
Exactly, which usually pushes the price down into the close. But we didn't see a massive sell-off here. The buyers held on to most of their gains.
So they were confident.
That suggests, at least for this one specific day, that the bulls were firmly in control.
So we are ending the week on a bit of a high note, kind of a deep breath after a sprint. But to understand if this green candle actually means anything, or if it's just a random blip, we really have to look at the broader context.
The larger battlefield.
Exactly. We have to look at the war that's been raging on this chart since November.
And war is definitely the right word for it. If you look over at the left side of the chart, going back to early November 2025, it was a slaughter.
Yeah, I'm tracing the price action back right now. In early November, this stock was trading way up near the 390 mark. It looked pretty comfortable up there.
It did.
And then it's like gravity just took over.
That is the November slide. And notice, it wasn't a sudden crash. It wasn't one big red bar that ruined everyone's day all at once.
No, it's a bunch of them.
Right. It was a slow, grinding, water torture kind of decline.
That's almost worse, isn't it? Psychologically, I mean, it's the death by 1,000 cuts.
Oh, psychologically, it is absolutely worse. In a sudden crash, you just panic and sell. You get it over with. In a slow slide like this, you keep telling yourself that it'll bounce tomorrow.
Right, just hold on one more day.
Exactly. It'll bounce next week. And it just never does.
Yeah.
You see that distinct series of red candles, lower highs, lower lows. Every single time the buyers tried to stand up, the sellers just knocked them right back down.
And that dragged the price all the way down to what looks like the 320s.
Roughly 320 to 330, yes. By early December, the sentiment on this stock must have been incredibly awful.
I can imagine.
Anyone holding it was underwater, and anyone watching it was probably terrified to even touch it.
And that is usually when the magic happens in these markets.
Correct. Which brings us to the event.
The event. I'm looking at mid-December on the chart right now, and honestly, you just can't miss it.
It jumps right out at you.
It really does. There is a massive green candle on the price chart, but what really grabs my attention is the bottom panel, the volume panel.
It's arguably the most important feature on the entire screen.
There is a single gigantic bar of volume. It looks like a skyscraper standing next to a row of tiny garden sheds. It just completely dwarfs everything else for months.
That volume spike is the footprint of the giant. Now, we don't have the news feed in front of us. Maybe it was an earnings surprise. Maybe it was a massive block deal.
Right, we don't know the exact catalyst.
But technically speaking, we don't actually need to know the why. The what is loud and clear on the chart.
And the what is that a lot of money changed hands very quickly.
An astronomical amount of money relative to a normal trading day for this stock. When you see volume that is 5, maybe 10 times the average, that is not retail traders. That's not you and me clicking buy on our phone apps.
No, that's the institutions, the big funds, the smart money.
Exactly. That massive spike tells us that big players decided the price had finally fallen enough. They stepped in and just absorbed all of that selling pressure.
They bought everything the panicked retail traders were selling.
Yes. They essentially put a hard floor under the market. Psychologically, that specific day in December changed the entire narrative from this stock is dying to this stock has found a bottom.
It's like they drew a line in the sand and just said, you shall not pass.
And it worked. The downtrend stopped completely dead.
But here's the thing that always confuses me, and I'm sure it frustrates a lot of people listening too. You see that massive save in December. You see the big money step in. So you expect the stock to rocket back up to 400 immediately.
You expect the V-shaped recovery.
Right. But that's not what happened here. Instead of a rocket, we got a waiting room.
The January consolidation.
Yes. Look at the entire month of January 2026.
It's just sideways.
Completely flat. The candles get really small. They're just alternating red and green, chopping back and forth roughly between 360 and 380.
This is what technicians call a time correction. The market is digesting that massive move from December. It's a tug of war.
A tug of war where nobody is winning.
Right. The buyers are exhausted from stopping the crash. The sellers are too scared of that big December volume to push it any lower. So nobody really does anything.
It just looks boring.
It is incredibly boring. But that boredom is actually a weapon.
How so?
The market uses boredom to shake out the impatient people. Retail traders get frustrated that the stock isn't moving, so they sell their shares and go buy something else that's flashing green that day.
And meanwhile...
Meanwhile, the smart money just sits there quietly and accumulates more shares at a stable price.
Wow. But while the price was boring everyone to death, something very interesting was happening to the indicators. I want to ask you about the Bollinger Bands.
Okay.
For those looking at a similar chart, those are the two wavy green lines sandwiching the price candles, right?
Yes, a very critical observation. In January, while the price went sideways, look at what happened to those specific bands.
They got really pinched together, like a corset pulling in tight.
That is a classic volatility squeeze. Bollinger Bands measure how wild the price swings are.
Okay.
So when they contract and narrow like that, it means volatility has dropped to historic lows. It's exactly like coiling a metal spring. You are physically compressing energy into the chart.
And basic physics tells us that you can't keep a spring compressed forever. It has to release.
Precisely. The tighter the squeeze, the more explosive the eventual breakout is going to be. The market was building up potential energy all through January. Everyone was just watching, waiting for the spring to snap.
And then February arrived, and the spring snapped.
It did. But unfortunately for the bulls, it snapped up, and then it snapped violently back down.
Right, the February fake out. I'm looking at the price action in early February. The stock rallies. It pushes up, it breaks out of that tight little sideways channel, it climbs right up towards the 400 level.
It even broke the upper green band.
Yeah, it breaks the upper Bollinger Band.
Yeah.
It looks like the start of a massive, undeniable rally.
It looked totally perfect. Technically speaking, that was a textbook buy signal. Breakout from consolidation, break of the upper band. A lot of traders probably jumped in right there, terrified of missing the boat.
FOMO, fear of missing out, just kicked in hard.
Oh, absolutely. And then
Rejection.
brutal rejection. Look at the series of red candles immediately following that high. They weren't just drifting down nicely, they are slamming the price down.
They really are.
The sellers were just waiting at that 400 level, which, by the way, is a very big psychological round number, and they just unleashed heavy supply onto the buyers.
It's the classic bull trap. They lure everyone in and then just pull the rug out from under them.
And that trap dragged the price all the way back down.
Yeah.
Which brings us to the present moment. We are back at 368. We are essentially back in the exact middle of the mess.
It really feels like we went on this huge dramatic journey. The grinding crash, the heroic institutional save, the boring wait, the fake breakout, and we just ended up right back at the start line.
Price-wise, yes. But structurally, the chart has completely changed. The board is set very differently now. We aren't just floating out in the open anymore. We are being actively squeezed into a corner.
Okay, let's talk about that corner, because we've done the timeline. Let's go down to the engine room and look at the technical indicators as they stand today on February 21st.
Let's start with those Bollinger Bands again. Remember how tight and pinched they were in January?
Yeah, but now they look blown wide open, like a trumpet.
That's expansion. Volatility is officially back, the market is awake, and it is dangerous again. But look closely at where the price is sitting relative to those two bands right now.
It seems to be floating in the lower half. In fact, looking at the recent action, it looks like it actually bounced off the bottom green line.
And it bounced. That is the silver lining for the buyers here. The lower Bollinger Band acted as a trampoline. It confirms that the floor is still holding. The technical support did exactly its job.
Okay, so the floor is holding firm, but what about the ceiling? Because I see this really smooth red line running right through the middle of the price candles.
Yes.
And it looks like it's been sort of tracking the price for months.
That is almost certainly a moving average line. Based on how smooth it is, I'd say it's likely a 20-day or a 50-day average. You can think of it as the mean or the average consensus of the stock's value.
And right now, for the most recent period, the candles have dropped below it. They are swimming underneath that red line.
Yes. And that is a significant problem. When the price is below the moving average, that line acts as a heavy ceiling. Technicians call it dynamic resistance.
Because it moves with the price.
Exactly. You can see on the chart, the stock tried to get back above it recently, but every single time it gets close to that red line, it just bumps its head and falls back.
So we have the lower Bollinger Band pushing up from the bottom, acting as support, and this red moving average line pushing down from the top, acting as resistance.
Exactly. We are caught in a vice. The price is being forcefully compressed into a tighter and tighter triangle. The physical space on the chart for doing nothing is just rapidly running out.
Which naturally brings us to the speedometer, the momentum of the stock. Let's look at the middle panel now. The RSI, the Relative Strength Index.
The RSI is honestly my absolute favorite lie detector.
A lie detector.
Yeah, it tells you if a price move is real and sustainable, or if it's totally overextended and about to snap back.
Okay, for the listener, the RSI scale goes from 0 to 100. If the line goes over 70, that's considered overbought, meaning it's running too hot.
Right.
And if it drops under 30, it's oversold, meaning it's too cold. So I'm looking at the white line for the RSI right now, and the current reading is sitting at roughly 47.50.
47.50.
That feels agonizingly average.
It is the literal definition of no man's land. It is the Switzerland of technical indicators.
Perfectly neutral.
Exactly. It's not hot, it's not cold, it's aggressively neutral.
So what on earth does that tell a trader who is looking at this?
It tells you that right now, at this exact second, neither the buyers nor the sellers have the actual advantage. It's a dead heat. But you have to remember that context matters.
Right, the history of the indicator.
Look back at late November on the chart. The RSI dipped well below that 30 line, That was the buy signal. That signaled the absolute bottom of that grinding crash,
And then look at early February. The RSI briefly peaked right near 70.
which was the sell signal. It signaled the top right before that brutal rejection and the recent drop,
And now it's just hovering in the middle.
which means the market has completely reset itself.
No.
The rubber band isn't stretched in either direction right now. It's completely slack. This right here is the calm before the next storm.
Which actually brings us full circle to that single green candle we started our discussion with. Today's specific price action. We know it closed green, we know it bounced. But I want to zoom in on the physical shape of that last candle one more time, because you mentioned a wick earlier.
Yes. The wick, that thin little line sticking out of the top and bottom of the solid green body, that wick is the actual story of the day.
Walk us through that. Explain the story.
Okay, so look at the bottom of the lower wick. It reaches down to the low of 354.8 euro.
Right.
That means at some point during the trading day, maybe it was 11 a.m., maybe it was noon, the actual price was pushed all the way down there. It was looking incredibly ugly. It looked like the floor was finally going to break.
Absolute panic time for anyone holding the stock.
Exactly. The bears were pressing their advantage.
Yeah.
But it didn't stay down there. The bulls stepped right in, bought the dip, and pushed the price all the way back up to close the day at 368.
Wow.
That long lower wick represents pure rejection. The market looked at those lower prices and essentially said, no thank you.
So it shows real resilience despite the overall recent drop.
It does. It tells us there are definitely buyers hiding down there in the mid-350s waiting to defend their territory.
But, and I really feel like I'm always the bearer of bad news on this show, I have to point out the one thing that looks incredibly weak to me, the volume.
Yes. The fly in the ointment.
We saw that skyscraper volume back in mid-December, the footprint of the giant. But look at the volume context for today on the far right of the bottom panel. For this nice little resilient bounce. It's tiny. It's barely a whisper.
It's relatively average to low volume. And you are right, that is a massive concern.
Why though? I mean, if the price went up, shouldn't we just be happy? A win is a win.
Because price only tells you what happened, but volume tells you how strong the conviction behind it was. A rally on low volume is like building a house on sand.
It's not stable.
Not at all. It means the price went up simply because no one was aggressively selling, not because everyone was aggressively buying.
Yeah.
It lacks that massive conviction we saw in December.
So it's fragile.
Extremely fragile. It honestly wouldn't take much selling pressure at all to knock it right back down. Technicians call this a divergence. The price action says strength, but the volume says uncertainty.
So let's synthesize all of this for the listener, based only on the visual evidence we've covered. We've taken this image apart piece by piece. We have the history of the painful crash, the massive institutional save, the stabilized boring wait in January, the failed breakout in February, and now this tight compression.
Right.
If you are looking at VIPND, what is the ultimate state of this stock?
The state is survival and neutrality. It is a stock that survived a near-death experience in November and December. It stabilized. It tried to fly in February and failed. And now it is just sitting in completely neutral territory.
RSI at 47.50, price at 368.
Exactly. It's sitting in the waiting room again.
But the walls of the waiting room are closing in this time because we have that lower Bollinger Band acting as a floor and that red moving average line acting as a ceiling.
We are running out of room on the chart. A decision has to be made very soon.
Before we wrap up, just a quick nod to the Nuvama watermark we can clearly see in the background of the image, anchoring the origin of the chart we've been referencing today.
Yes, always good to note the source platform.
So we've laid out the entire map. The price is literally squeezed between the red moving average line above it and the recent lows below it. The RSI is dead center at 47.50. The market has essentially hit the pause button on this stock.
A total stalemate.
Right. So we'll leave you with this final provocative thought to mull over. The silence on this chart right now, this low volume bounce, it is definitely the calm before the next decision. The real question for you is, when the massive volume inevitably returns like it did back in December, which way will the rubber band snap?
That is the ultimate question.
Thanks for joining us for this deep dive. We hope it gave you a new perspective on reading the story behind the data.
See you on the next one.